Hey, friend, welcome back to the Live Off Rent Show, where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, reach financial independence, all that good stuff. As always, I'm your host, Brian Davis, co founder of Spark Rental, and I'm on this journey with you. Every month, sit down with different sponsors and vet them in our co-investing club. And I invest right there in the trenches along with you. So without further ado, I am super pumped to introduce today's guest. Jay Scott is an entrepreneur, investor, advisor, author, and partner at Bar Down Investments, where they focus on buying and repositioning large multifamily properties. In the past 15 years, Jay has bought, built, rehab, sold, and lent on and held over $150 million in real estate around the country. He's the author of 5 BiggerPockets books on real estate investing, including the bestseller, The Book on Estimating Rehab Costs. And he's the co-host of the Drunk Real Estate Podcast, which is an awesome podcast, by the way. It's so much fun. So Jay, welcome to the show.
Thanks, Brian. I really appreciate being here.
Yeah. So Jay, we love to start by just asking people how you got into real estate investing in the first place, because those are always interesting stories. And then inevitably, you have a winding journey from there to where you are today. So yeah, let's rewind the clock here. Take us back.
Yeah, I'm not sure it's that interesting of a story. It was actually, I fell into real estate by accident. So I'm an engineer by education and previous trade. So I worked in Silicon Valley for much of my career until 2008. Back in 2008, my soon-to-be wife and I, she was also in the tech industry, decided to get married. And we were working 80 hours a week, not the cliche 80 hours a week, like literally we're working 80 hours a week. She was traveling 3.5 weeks a month for her job. I was traveling 2 weeks a month for my job. We never saw each other. And we knew that if we were going to get married and continue that kind of lifestyle, it wasn't going to be conducive to starting a family and to having a good relationship and all those other things that you want when you're getting married. So 2008, we got engaged and we both decided to quit our jobs and move back to the East Coast where our families were and figure out something else to do outside of technology. So in 2008 summer, we moved to Atlanta, Georgia. We were trying to figure out what it is exactly that we wanted to do. We had talked about starting a small business. We had talked about buying apartment complexes. We had talked about passive investing. We had talked about all different types of things. And one day, while we were still trying to figure it out, my wife was watching a flipping show on HGTV. And she said, well, while we're trying to figure out what we want to be doing with our lives, why not flip a house?
Why not?
And why not? We were both in our mid 30s. We had literally just bought the first house that we ever owned, the one we were living in. I knew nothing about real estate. I knew nothing about renovations. I knew nothing about flipping houses or anything related to real estate investing. But I said, let's give it a try. And so went on the internet, tried to learn. We bought a house. We ended up buying a second house and a third and a fifth and a 10th and a 50th. And before we knew it, we decided, I guess, we were real estate investors without actually actively making that decision. So between 2008 and 2018, we flipped about 450 houses. And then in 2018, after getting severely burned out on single family and flipping, we decided to move into multifamily. And so I've been investing in multifamily, syndicating and owning and operating myself for about 6 years now.
Man, 450 flips. That's, I mean, did you guys stop working day jobs at a certain point? Was this full time for one of you?
This was full time for both of us.
So yeah, I was going to say, I don't know how else you could do that many in that time frame.
When we left the tech industry, we basically said, we're not going to go back to working for somebody else. We're going to figure it out and we're going to do something on our own. And so from the day we quit our day jobs and moved to the East Coast, we were entrepreneurs, even though we didn't know exactly what we wanted to be doing. And real estate is what we ended up doing.
Well, so many people end up in real estate, not because they had some like burning, passionate desire, to be in real estate necessarily, at least in the beginning. But it seems accessible to people. And then over time you grow to fall in love with it. So, which it sounds like is what happened with you guys.
Not at all.
Oh, well, so I guess you hate real estate nowadays.
I do not like real estate. And people freak out whenever I say that, given how long I've been in this business and how much I've done in this business. But the reality is, I do not like the nuts and bolts of real estate. What I like is I like running a business. I like growing and scaling a business. I like being an entrepreneur. And part of the reason why I think my wife and I were successful in real estate is that neither of us really liked it enough to get involved in the day-to-day aspects. So we knew that we were never going to be good contractors. We didn't enjoy it. We weren't good at it. We didn't have the background. We knew we probably weren't going to be good at anything related to real estate. But what we were good at was running a business and growing a business and scaling a business. We were good at hiring people and managing people, building teams. We were good at the inventory management, the cash flow management, and understanding the financials of the business and how to grow the business and how to raise capital, and how to find capital and how to structure deals. All of those things that are not unique to real estate, but are uniform across any business or any entrepreneurial venture that you're ultimately going to run. And so that's what we were good at, and that's what we enjoy doing. And so we focused our time on growing our business and scaling our business as opposed to working in the business, which again, two things that are something that neither of us really liked.
Well, there's something to that because, it's far too many entrepreneurs start out by just taking whatever their day job was and then saying, "Oh, I'm going to go like do this on my own," right? I'm good at XYZ like skill set in this industry, so I'm just going to go work for myself and do it, not realizing that most of the skill of being an entrepreneur is actually working on the business itself, not in the business, things like marketing and raising capital and all those things that you just mentioned. So, maybe you're onto something there. Uh, Now I'm
It
curious.
definitely worked for us.
Yeah. Yeah. And, to your point as well, that work within the business, 99% of work within the business can be delegated to someone else. You can hire someone to do that work. Whereas some of that top level stuff that you're talking about that you and your wife are very good at, that's stuff that you really can't delegate to someone else, or at least a lot of it you can't or shouldn't.
And,
Yeah.
and not only is it stuff that can't be delegated, but it's also the stuff that really earns you the value of being an entrepreneur. I see people all the time that they decide, I want to save money on my flip, so I'm going to paint the house myself, or I'm going to lay the tile myself. And my response there is, if you can hire somebody at $25 an hour to paint your house, basically you painting your house is earning yourself $25 an hour.
Exactly.
You're giving yourself a $25 an hour job. I left a job that was making high six figures. I'm not going to leave a high six-figure job to take a job that's making $25 an hour. So I had to ask myself, what are those jobs in real estate or as being a business owner? What are those jobs that are going to allow me to earn $500 an hour, or $1,000 an hour, or $10,000 an hour? And at the end of the day, it really boiled down to finding great deals and finding the money for those deals. Those were the two things that were earning the big bucks, because those were the things that you can't just hire out for $25 or $50 an hour.
Yeah, exactly. But, so many entrepreneurs, they struggle to give up that control, right? And that's why so many of them are basically doing $25 an hour tasks within their business and then wondering why they're spinning their wheels within the business and not getting anywhere. So I love all that. To get back to real estate, I want to hear more about your transition from single family flips to multifamily syndications, because that's a transition that I think a lot of investors would be at least curious to learn more about and potentially make themselves. But I think a lot of people don't know where to start with that. So walk us through how you guys made that transition.
Yeah. So, well, the decision kind of came again, not so much planned, but a little bit accidental. When we stopped flipping houses in 2018, we went back to kind of that, okay, what do we want to do next? What's going to be the next business venture? What's going to be the next entrepreneurial venture? And I had assumed originally that it wasn't going to be in real estate. And what I found was that after stopping flipping, we had all of this money coming back to us, all the money that we had been putting into flipping multiple houses at a time for many years came back to us and was sitting in a bank account. And suddenly I had nothing to do with that money. And I knew I wasn't going to use it all to start a new business. I wasn't going to take everything I had and throw it into a business. So I knew I needed to invest that money. So I said, before I start thinking about what's next, I need to figure out how I'm going to invest what I have now. And after looking at various asset classes, after thinking through where I thought the economy was back in 2018, I thought we were probably a little bit closer to a recession than we actually were. I decided that the best place to be investing, or the place where I wanted to be investing, was multifamily real estate. It's one of the best risk-adjusted asset classes. It's relatively recession resistant. It's relatively you can diversify relatively easily. And so I said, I want to be investing a lot of this into multifamily, even though that's not what I was doing or had any experience in. So I started looking around to see, how do I invest in multifamily? And what I realized was there were people out there that would take passive investors and sponsors who would put together large deals, and you could invest with them. And unfortunately, I'm not someone who trusts other people with my money very well. So I said, well, this is interesting. I could kind of do the same model myself, but instead of bringing in other investors, or in addition to bringing in other investors, I can invest my own money in the deals that I'm running if I learned how to do multifamily. So I reached out to a friend of mine. Her name was Ashley Wilson, or is Ashley Wilson, and we had known each other for a few years, and she was crushing it in multifamily. And I basically asked her if she would teach me the business, and I offered to work for her for a year, and basically give her my time and knowledge and energy and whatever for a year if she would teach me the business. And she said yes, and so I worked for her for a year. And after that year, we realized that we had some very complementary skill sets. The stuff that she was good at, I wasn't so much. The stuff I was good at, she didn't really enjoy doing. But put us together, and we actually made a pretty good team. And so in 2019, we decided to team up, and we started investing together. And we've been investing for about 6 years. We have about 1,100 units across the Southeast and Texas.
Awesome. Well, first of all, good for you for going out and finding a mentor, because so many real estate investors, whatever their niche or their strategy is, don't do that. They think, oh, I can just go it alone. I'll figure it out as I go. 20 years ago, I was that idiot doing that, made every mistake in the book, when I first got into single family rentals, and lost a bunch of money because of it. So yeah, good for you for going out, finding someone who was successful in the type of investing you wanted to do, and then offering to work for her for a year. Every investor who's just starting out should take a page out of that book. So just highlighting that for a moment. So you specialize in multifamily properties in the Southeast. Tell us about why, your exact strategy. What's your niche within multifamily syndications?
Yeah, so we look for properties that are 150 units and above, generally Class B areas, C plus to A minus, that are in somewhat of distress, either physical distress or management distress, need some renovation or management improvement, so that we can add value there. We like stuff that's built between 1980 and 2010, so not too old, not too new, in places where we're seeing good job growth and good employment growth and good employment diversity. And it's really that simple.
All right. And how the last 18 months or so, or even 2 years, I guess at this point, have been pretty rocky in the multifamily
Yep.
industry. So, tell us how has that been for you guys? What kind of challenges have you seen? What's been going on for you over the last 2 years in the industry?
Yeah, so it's been a tough couple years. So we had 3 properties going into 2022. Luckily, we were pretty conservative going in. It was pretty clear to me back in 2020, 2021, that we weren't going to see that low interest rate environment forever. And so we made sure, when we bought the properties that we were holding through this period, we made sure we got long-term fixed rate debt. One of them, we got a little bit shorter term fixed rate debt or floating rate debt with a rate cap. Long-term floating rate debt with a rate cap. So, but all of our properties were relatively well insulated against the interest rate changes. But when we hit March of 2022 and interest rates started to go up, what we found was it became very difficult to find additional properties. Sellers were no longer willing to sell it at a discount. They basically wanted the same price they were seeing for their properties before interest rates started going up. We, as buyers, obviously weren't going to pay the premium that we had to pay given interest rates and our higher debt service. So we weren't doing many deals. We didn't do any deals in 2022. And last year we said, okay, well, let's talk to our investors. Let's see what our investors are looking for right now, because maybe we're missing something. And what I found from my investors was they recognized that things were tough in the multifamily space, and they were in a lot of deals that had stopped paying distributions. They had been in some people's deals that were getting capital calls. Some of our investors were in deals that were getting foreclosed on. And a lot of our investors were starting to get a little bit scared, and they said, we'd love to have a lower risk option to invest in moving forward, at least for the time being, because we don't know where the market's headed. And so last year, we actually launched a fund, a preferred equity fund, that is essentially a low risk fund that we were able to offer our investors the opportunity to invest in multifamily, but in a lower risk way than a traditional syndication or fund. And I'm not trying to pitch anything. I'm just want to point out that for anybody out there that feels like things are a little bit risky these days, there are lower risk investments out there that can still generate decent returns, decent cash flow, tax benefits, et cetera. And so for the last year, we're still looking for traditional syndications. And I suspect that over the next 6 to 12 months, things are going to open up a little bit more. We're starting to see some more deal flow these days. But in the meantime, we're kind of focused on our preferred equity fund and doing those types of deals instead.
No, that makes sense. And it's just out of personal curiosity, do you accept non-accredited investors in your fund? Because our co-investing club, every month we're looking at different sponsors' deals, but some of our members are non-accredited. So, it's a priority for us. We only look at deals or funds that are open to non-accredited investors as well.
Yeah, so we made the decision a couple of years ago that we were not going to do any 506B, any non-accredited deals, and nothing wrong with them. But for us, because we do a lot of 506C deals and we do a lot of advertising for those deals, mixing 506C accredited only deals with 506B non-accredited deals can present some legal challenges, some risk when you're advertising or marketing for investors for one deal. Sometimes they end up in another deal, and if we can't clearly delineate what deal we had originally marketed them for, and they end up in a deal that they shouldn't have ended up in, it just creates a little bit of risk that we decided early on that we didn't want to take.
Yeah, no, that makes sense. And there's certainly plenty of regulation in this industry, no question. So you guys are focusing on lower risk preferred equity investments at this point. What kind of returns are you seeing on those investments?
So, well,
or rather, what are your investors? What kind of returns are your investors seeing on those?
Sure. Well, I will point out that people talk about like lower risk investments generally involving going down the capital stack. So instead of investing in equity, you invest in debt. You become the lender, or your fund becomes the lender. That in theory is a lot lower risk than being an equity partner. And then in the middle of the debt and the equity is that preferred equity piece, which is kind of a type of equity that's safer than regular equity, not as safe as debt, whatever. But it's important to note that there are different levels of risk even within each of those tranches. So I could be a lender, and just because I'm lending money doesn't mean that it's necessarily a low risk venture. There are lenders out there that will lend to higher risk ventures, or they'll lend higher LTVs, or they'll lend in places that are more risky. And so for us, it's our goal is always, with this fund at least, our goal is to focus on less risk at the expense of returns. So you can certainly find preferred equity investments that pay more than ours, but currently we pay 12% average annual return. So 6% per year in monthly cash flow, and then another 6% deferred till the end of the deal. So 6% per year paid now, 6% per year paid when the deal sells. So average of 12% per year.
Hey, that's perfectly respectable, right? I mean, if I earned 12% on every investment that I ever made, I mean, I'd be a rich man right now.
And I'm a big fan of diversification, and there's a time and a place for regular syndications. I still invest most of my money in stuff that's higher risk than my fund. But for a lot of our investors, especially those who are a little bit older, those who need the cash flow, and having the consistent cash flow and the lower risk is a good thing. And so everybody just needs to decide where they are in their career and what's right for their portfolio today.
Yeah, I know. It makes total sense. So let's dig a little bit more into risk for a second. So
Yeah.
I'm curious to hear your thoughts on what are some of the risks in today's market that maybe not enough people are talking about, either on the GP side or on the LP side. What are some of those risks that you think are underappreciated right now, and how are you guys mitigating against both those risks and any other risks in your current fund?
Yeah. So, I mean, luckily, I think there are fewer risks today than if you would have asked me this question a year ago or
Agreed.
18 months ago.
Yeah.
So that's one thing, at least in the multifamily space. But the interesting thing is when we talk about real estate, a lot of people think real estate is one asset class. Real estate's a lot of asset classes. And so if I were going to talk about risk in the single family world, my response would be very different than the multifamily world or office or retail or industrial or self-storage. Every asset class is going to have a different set of risks, a different type of risk, a different amount of risk. And so in the multifamily space, I think one of the bigger ones that we're facing, at least this year, probably be alleviated by next year, but is just the amount of inventory getting ready to come online. So if you look at housing starts, it looks like we're going to have about 650,000 units in the multifamily space coming online in the U.S. In 2024. That's a lot of units. And
A lot
so,
of units.
yeah. And so a lot of those units, most of those units are going to be A-class properties. Builders these days don't tend to build B or C class properties just because of the cost. And so, or the relative cost. And so there's going to be a lot of A-class inventory coming online this year. So one of the things that we're doing is we're pushing our strategy down the class line a little bit. Instead of focusing on B plus or A minus class properties, we're going to focus on the solid B or maybe even B minus class properties because we're not going to get hit on our absorption rates nearly as much when all these new units come online. So number one, I think a lot of LPs, whether they're passive investors or GPs, should be cognizant of the fact that there is going to be a good bit of new inventory coming online in 2024, and that can impact your absorption rates and potentially your rents and your vacancies. So that's number one. Number two, there are still a lot of migration trends that we're seeing. Pre-COVID, migration was pretty stable. People weren't leaving one state and going to another state too much. We didn't see certain states losing great population, other states gaining great population in short periods of time. Obviously, during COVID, we started to see a lot of that. A lot of people moving from the north to the south, the west to the east, a lot of people moving into the middle. That has slowed down a good bit, but it certainly hasn't stopped. And I think over the next couple of years, we're likely to see those migration trends continue either in the same way or in different ways. And I think both LPs and GPs need to be cognizant of the fact that people haven't stopped moving, but they aren't necessarily moving to the same places. So I live in Florida. Luckily, I don't invest in Florida because we've seen some issues in Florida. Insurance costs have gone through the roof. Property taxes have gone through the roof. We've seen a lot of natural disasters. And one of the things that we're starting to see, I'm in Southwest Florida. I'm on the west coast of Florida. One of the things that we're starting to see is for the first time in a couple of years is that influx of population is starting to slow down. We're actually starting to lose people where I live. And so I expect that we're going to see rents start to soften over the next year or two. I expect we're going to see vacancies increase over the next year or two. And even just 6 or 12 months ago, the thought that Southwest Florida would see a slowdown in population growth was just completely non-existent. Nobody thought that was the case, but things change quickly. And so I think there are going to be other places where we've seen population growth over the last couple of years where that's slowing or stopping. There are going to be places where we've seen population loss over the last couple of years, but we're going to start to see population growing again. A lot of big cities are starting to get population back. And so I think GPs and LPs need to be cognizant of these population trends because there's some risks there. And then I still think that there are some interest rate risks. So The Fed is currently predicting 3 cuts this year. I think that's unlikely. Maybe things will change. Who knows? You never know what's going to happen tomorrow or next week or next month. But I think there's a really good chance that our economy kind of stays on track for the next 6 to 12 months through the election. And if that happens, I think it's unlikely that we're going to get 3 rate cuts this year. And so I know a lot of people are factoring those rate cuts into their ability to be able to refinance or their ability to get new debt on a new project. We have this thing called rate caps in the multifamily space. It's basically an insurance product. When you get a floating rate loan, you buy this rate cap insurance policy that ensures that if rates go up, you're not on the hook to pay it all. And banks require that if you get a floating rate loan that you have to buy this insurance policy. Well, these insurance policies over the last 3 years have gone up 10, 20, 50 times as much as they were. And so it can be very expensive to buy these insurance policies. And so if you have a floating rate loan and that insurance policy is coming due, it's very possible that you could end up in a situation where you have to pay $500,000 or $1 million for a new policy. And so this is hitting a lot of multifamily operators pretty hard as well. So in the multifamily space, I think there are still a good number of risks. In the single family space, I don't think there's many risks. I think single family is probably going to stay propped up for the foreseeable future. Supply is tremendously low. We don't see a ton of inventory coming online in most places. And there's not a lot of incentive for most people to sell. 78% of, I think the number is 78% of homeowners have mortgages under 4%. And if you have a mortgage under 4% and prices are inflated, there's just no incentive to sell unless you're in a real dire situation, right? Because you're going to lose that great mortgage and you're going to have to find another overpriced house. And so a vast number of homeowners are not going to sell until interest rates start to come down. And again, I don't think that's going to be this year. So I think single family is poised to do pretty well as well this year.
Yeah, no, those are great points across the board about some of the risks in the market. Thank you for sharing those. And I share your caution about interest rates coming down this year. The Fed has been signaling that for the last 4 months or so, but who knows? I mean, inflation has been very stubborn and it is not tamed. So we'll see. We'll see what the Fed actually ends up doing. But there might be a lot of disappointed investors out there, if the Fed does not cut interest rates this year, but it would not surprise me in the least if they don't cut even once. So, yeah. Jay, how can people connect with you if they're interested in investing with Bar Down Investments?
Yeah, if anybody wants to connect, reach out to me by email or any other way. You can find all my information if you go to jscott.com, just the letter J, SCOTT.com. That links out to everything I've got.
Jay, thank you so much for joining us today. This was a lot of fun. And guys, if you enjoy these conversations that we have, please rate, review the show. It means the world to us. And we will catch you same place, same time next week. Have a good one.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.